In a single trading session, silver fell by 27%, dropping from its historical peak to levels adjacent to where hundreds of thousands of derivative contracts remain open. As the market prepares to reopen, the central question is no longer will price move up or down, but rather, who is trapped inside this system, and for what reason? This video does not follow news cycles. It traces CFTC positioning data, COMEX inventory dynamics, and historical precedent to examine silver's next phase, within a context defined by a weakening US dollar, ongoing gold accumulation, and industrial demand that has not vanished. When the market closed at the end of the weekend session, the dominant atmosphere was not panic, but a dense and unsettling silence. The chart had completed its visible function, but the system itself had not. Screen prices had changed, yet underlying positions remained intact, contracts were still unsettled, and physical metal does not relocate simply because a trading session has ended. It is precisely this interval that marks where the real narrative begins, not at the moment headlines emerge. Had you been inside a trading room at that time, you would have observed something starkly different from the portrayal circulating on social media. There was no disorderly stampede. Instead, there were brief phone calls, balance sheets reopened, and a single question resurfacing repeatedly. Who is being forced to reduce risk first, and who still has the capacity to wait one more cycle? At this juncture, the silver market is no longer governed by crowd psychology, but by very specific tolerance thresholds embedded within the financial system. The recent collapse is often attributed to a single catalyst, yet such explanations ignore the most critical reality. Silver was already under structural strain before any news event appeared. Months of rapid price appreciation did not merely reflect demand, they reflected the accumulation of leveraged positioning across derivative instruments. As this layer of exposure thickens, the market becomes dangerously sensitive. At that point, any sufficiently forceful disturbance, regardless of origin, automatically activates a chain of technical responses. What follows is no longer discretionary, it becomes mandatory. Once this mechanism engages, it does not discriminate between correct and incorrect positioning. Weaker positions are compelled to close first, generating immediate selling pressure that drives prices downward faster than human decision-making can react. This is why the move unfolded within a single session rather than over several days. Its signature is that of a systemic pressure release, not a long-term reversal in collective belief. However, stopping the analysis there still captures only half of the picture. The other half resides in a critical divergence. While paper prices collapsed, physical metal flows showed no evidence of excess supply. There was no broad liquidation of physical silver, nor any disruption in industrial consumption channels. These two domains responded differently, and it is precisely this misalignment that forms the source of the next phase of tension. This is where the channel's analytical lens must be emphasized. Markets are not monolithic entities. They are layered structures in which multiple mechanisms operate simultaneously. When derivatives unwind, physical supply is not obligated to follow. And when these layers decouple, volatility ceases to behave in a linear fashion. Those who focus solely on charts perceive disorder. Those who examine structure recognize coherence. That coherence becomes clearer when silver is examined alongside the US dollar and gold. The dollar is under sustained pressure from an expansionary fiscal backdrop, while monetary flexibility is increasingly constrained. Gold reflects this tension directly due to its monetary role. Silver behaves differently. It responds with greater delay, but once engaged, its movements tend to be more violent because they incorporate an industrial demand component. This dual identity is precisely what makes silver the most difficult asset to interpret, and the most frequently misunderstood. After the recent decline, the key variable is not absolute price, but relative relationships. The gold-to-silver ratio did not surge in a manner consistent with a market rejection of silver. This indicates that capital has not exited the metal's narrative, but has instead repositioned within it. This detail may appear minor, yet it is structurally decisive, because it signals that the underlying framework of the story remains intact. At this point, analytical focus must shift toward industrial demand, an element routinely undervalued in short-term market commentary. Silver is not held solely for monetary speculation. It is consumed due to tangible production requirements. Industrial processes do not halt simply because prices fluctuate. When financial markets liquidate, many manufacturers instead identify opportunities to stabilize input costs. This behavior does not generate headlines, but it establishes a quiet and persistent support. The simultaneous presence of financial liquidation and physical stability pushes the market into a uniquely tense configuration. In such conditions, attention converges on positioning data, not to forecast price direction, but to determine who is retreating and who remains anchored. As supply-linked entities gradually reduce hedging activity while financial participants are forced to compress risk, the market enters a fragile equilibrium well documented in precious metal history. History suggests that such moments rarely resolve smoothly. Once technical selling pressure dissipates, the question transforms. How much silver is genuinely available for sale at the newly established price range? If the answer lacks clarity, the market is compelled to probe its own structural limits once again. All of this unfolds within a macroeconomic environment that is anything but neutral. Fiscal pressure constrains the durability of restrictive monetary policy, while economic growth remains tied to sectors that are among the most intensive consumers of silver. This contradiction defines the current phase. Policy actions generate short-term volatility, while economic structure sustains long-term pull. When these forces collide, markets do not glide, they jolt, disorienting participants who lack structural perspective. At this stage, the tension embedded in the narrative becomes explicit. The issue is not whether silver has become overheated or has completed its cycle, but whether market structure is thinner than widely assumed. When available metal is limited, each round of repositioning leaves an outsized footprint. To those watching only price, this appears irrational. To those examining mechanisms, it is inevitable. From an editorial standpoint, this analysis does not seek to deliver a definitive forecast. Its purpose is to clarify what the market is doing and why. The focal point remains the interdependent relationship between the US dollar, gold, and silver. The value lies in weaving publicly available data and historical precedent into a coherent framework that allows the audience to perceive structure beneath surface-level volatility. If the channel has a defining signature within this content, it is the refusal to ask, "Where will price go?" and the insistence on asking, "Where is the system under strain?" That question sustains engagement, invites debate, and brings viewers back, not merely to learn what happened, but to understand why it happened. This is precisely why the recent collapse in silver should not be interpreted as an endpoint, but as a systemic stress test. When the opening question asks what is truly unfolding after such a sharp decline, the answer is not found in price itself, but in the market's response to stretched structure. In the present political and economic environment, marked by fiscal expansion, constrained monetary policy, and mounting scrutiny over the long-term purchasing power of fiat currency, the roles of gold and silver are once again repositioned at the core of modern monetary history. Notably, these shifts do not materialize over days or weeks. They develop over quarters and even years as policy, technology, and physical demand collide. This may represent only the opening phase of a period in which precious metals are no longer treated as peripheral assets, but as indicators of systemic stress across the global financial architecture. How do you assess the implications of this process for the US dollar, global capital flows, and silver's role in the coming quarters? Your perspective is worth serious discussion. This is Money Cycles, We do not chase headlines. We examine the mechanisms beneath them. And if you want to follow the next movements as this structure gradually comes into focus, you know where to find us.